Hello and welcome to Capital Investments, the channel that provides insights on how to grow your wealth. Here we delve into the intricate world of finance, unpacking strategies and opportunities that can potentially turn a dime into a dollar, 100 into 1,000, and so forth. Today, we're peeling back the layers of a financial entity that often elicits intrigue and curiosity. Hedge funds, shrouded in the fog of complexity, often seem like a mystery to many. But fear not, because we're here to dispel the confusion and shed light on this fascinating financial tool. We will explore how hedge funds operate, the strategies they employ, and most importantly, how they make money. By the end of this video, our aim is to provide you with enough knowledge to understand the workings of hedge funds and possibly how to leverage them in your investment journey. Stay tuned to uncover the secrets of hedge funds. First, what exactly are hedge funds? This question often sparks a myriad of complex explanations. But let's simplify it. At their core, hedge funds are essentially investment vehicles, pools of capital, if you will, that aim to generate high returns for their investors. Imagine an orchestra where each musician plays a different instrument, but together they create a harmonious symphony. Similarly, hedge funds encompass a variety of investment strategies, each one playing its part to create a profitable outcome. These strategies range from investing in public equity and bonds to more complex ones like derivatives and leverage. The ultimate goal is to earn active returns, or, in simpler terms, to make more money than what traditional investment strategies would offer. Now, you might wonder who can invest in these funds. Well, hedge funds are typically open to a limited circle of investors. These are not your everyday mutual funds that anyone with a few $100s can buy into. No, hedge funds are the playground of accredited investors, high net worth individuals, and institutional investors. These are folks who can afford to take on higher risk for the potential of higher returns. It's also important to note that hedge funds operate with less regulatory oversight than other investment vehicles. This flexibility allows them to engage in aggressive investment strategies. But remember, with potentially higher returns comes higher risk. So in essence, a hedge fund is like a private club where the wealthy and financial institutions pool their money together. The fund manager, the maestro of this orchestra, then employs a variety of strategies with the aim of hitting high notes of returns, even when the broader market might be off-key. Now that we know what hedge funds are, let's delve into their strategies. Hedge funds employ a variety of strategies to increase wealth with a universe of investments to choose from. Hedge funds have developed an array of tactics to maximize returns and manage risk. Let's delve into a few of these strategies. First, there's the long-short equity strategy. This is the classic hedge fund approach where funds take both long positions, buying with the expectation that the asset will increase in value, and short positions, borrowing and selling with the expectation that the asset will decrease in value. This strategy aims to profit from both rising and falling markets, providing a hedge against market downturns. Next up is the market-neutral strategy. Here, hedge funds aim to take advantage of price differences between related securities by taking offsetting long and short positions. The goal is to have a net market exposure of zero, hence the term market neutral. This strategy aims to earn a return regardless of the overall market direction. Then there's the event-driven strategy. This is where hedge funds seek to capitalize on mispriced securities that may be affected by corporate events such as a merger, acquisition, or bankruptcy. The fund manager's skill in predicting the outcome of these events can lead to substantial returns. Lastly, we have the macro strategy. Macro hedge funds bet on macroeconomic trends using futures and options. They might take positions based on expected changes in interest rates, inflation, or other economic indicators. These funds can be highly volatile, but they can also deliver substantial returns if the manager's predictions are correct. So there you have it, a brief overview of some of the key strategies employed by hedge funds. Each strategy requires a unique set of skills and knowledge, and each carries its own risk. But one thing is certain: these strategies, when executed correctly, can yield significant returns. But how exactly do hedge funds make money from them? Let's unravel that in our next segment. Now let's get to the heart of the matter. How do hedge funds make money? Well, to understand how hedge funds make money, we need to talk about two primary sources of income: management fees and performance fees. These are the lifeblood of a hedge fund, and they work in a rather interesting way. Firstly, let's discuss management fees. These are the steady income that hedge funds can count on, rain or shine. They are typically set as a percentage of the total assets under management, or AUM. This fee is usually around 2%, but it can vary depending on the fund. So if a hedge fund manages $1 billion, a 2% management fee would yield $20 million annually. This fee is used to cover the operating expenses of the hedge fund, including salaries, office space, research, and more. Now, you might think that's a pretty sweet deal, isn't it? But here's where things get even more interesting. Hedge funds also earn what's known as performance fees. These are the real game changers and can lead to some serious earnings. Performance fees are a percentage of the profits earned by the hedge fund. This percentage is often around 20%, but can be higher for top-performing funds. If a hedge fund makes $100 million in profits, a 20% performance fee would mean a cool $20 million in the fund manager's pocket. These fees are what incentivize hedge fund managers to strive for high returns. The more profits they generate for their investors, the more they earn. It's a win-win situation, but it's also a high-stakes game. If the fund doesn't perform well, the managers don't get their performance fees. However, it's important to note that these performance fees are subject to what's known as a hurdle rate and a high watermark. A hurdle rate is a minimum return that the fund must achieve before it can collect performance fees. A high watermark, on the other hand, ensures that managers can't collect performance fees for simply recovering previous losses. In essence, these structures are designed to align the interests of the hedge fund managers with those of the investors. They ensure that the managers are rewarded for generating real consistent profits, not just for churning assets or recovering from a bad year. So, as we can see, hedge funds have a unique approach to generating profits. They rely on a combination of management fees for steady income and performance fees for those big wins. It's a model that rewards skill, strategy, and risk-taking, and when it works, it can lead to some truly impressive returns. In conclusion, hedge funds use a range of strategies and fee structures to make money. In the grand scheme of things, the financial world is a labyrinth of complexity and nuance, yet some of its most intricate aspects can be boiled down to a series of fundamental principles. Hedge funds, for instance, are no exception. Despite their reputation for complexity, the manner in which they generate income is based on a blend of strategies and fee structures. We've unpacked these strategies: long-short equity, market-neutral, event-driven, and relative value, to name a few. Each of these tactics plays a vital role in the hedge fund's ability to generate returns regardless of market conditions. They are the foundation upon which these funds build their profit-making potential. But it's not just about the strategies. The fee structures employed by hedge funds also significantly contribute to their income. The standard 2 and 20 model, which consists of a 2% management fee and a 20% performance fee, is a testament to this. This structure ensures that hedge fund managers are rewarded for their performance, encouraging them to strive for the highest possible returns. However, it's important to remember that hedge funds are not a one-size-fits-all investment solution. They require a substantial initial investment and carry a higher degree of risk compared to other investment types. Investors must be prepared to withstand potential losses and have a clear understanding of their financial goals and risk tolerance. In the world of investing, knowledge is power. Understanding how hedge funds operate and make money is crucial for anyone considering investing in them. Thank you for tuning in to Capital Investments. Don't forget to subscribe for more insights into the world of investing.